It's now time for us to start our ninth lesson. So let's go ahead and get going. As usual, I need to remind you to take a few moments to read the disclaimer. All right, now, as far as our lesson for today, we are going to begin by taking a look again at the open. As I've emphasized in the past, the open is a very important period of the day. It gives us a great deal of valuable information and insights as to what is likely to happen during the trading day, and it also begins to open up the door for potential high probability trading opportunities. So it really makes a lot of sense for us to focus on this period and learn to analyze it carefully, understand it, and certainly be able to capitalize and benefit on from the opportunities that become available during that period. So we're going to revisit how to be able to determine the day's high and the day's low very early in the day during the initial balance period. We are then going to begin talking a little bit again about the open relative to the prior day's value area and the type of insights and the type of possibilities that that presents to us. And last but not least, today we are going to talk a little bit about what I call the anatomy of a trade. In this phase of the course now, we are going to start looking and more at trading opportunities, identifying the opportunity and identifying what we need to do to be able to capitalize on it in terms of how do we enter the trade, when do we enter it, where's the best entry, and so on. So we need to spend a little bit of time taking a look at the anatomy of the trade, how we structure our trades in general, and the key elements that we have to look at before we actually take a trade. And so I hope that you will implement and use some of these tools that we're going to be talking about. All right, so let's begin with ways that we can identify the high or the low for the day very early on during the initial balance when the market opens. Really, the high and the low are the extreme levels or the extreme value areas for the upcoming day. So what we're trying to do early on, as soon as the market opens, is to identify where the extreme is likely to be. And naturally, this is important for us because if in fact we could do this and do it correctly, this becomes very powerful and very valuable information because it will translate to trade opportunities that will make money for us. Imagine if you're able to actually identify the low of the day or the high of the day very early on in the day. So you sort of begin to sail with the wind at your back. Now, by the way, being able to identify the high and the low for the day at an early point like that is one of the key advantages or benefits that the profile offers us. There aren't many other tools that can give us the type of analysis that will yield correct results as the profile often does in terms of being able to identify the high or the low for the day. All right, so how do we go about this? We know that the market opens and we know we're going to have the initial period, and the initial period, always remember, is the first hour. It's the initial balance, period A, the first half hour, followed by period B, the second half hour. So the first step, or the first piece of the puzzle that we want to look at is what is really happening during that initial period, the initial balance period, during period A and period B. Another tip I want to give you is often people sort of decide, oh, I know where the high is, I know where the low is, and act on this information a little bit prematurely. It takes a little bit of patience. Let the market tell you. Don't try to second guess it and don't try to get ahead of yourself or ahead of the market. Take your time so that you can identify and learn to identify correctly either the high or the low for the day. Now, here's a tip I'm going to give you that really makes it often quite easy to identify, and that is learn to look for the tails. In period A and period B, if we begin to see a tail developing in period A, or perhaps both in period A and period B, then that gives us a very good clue as to the direction and the momentum in the market. So let's take a look at an example here together. We have the area of the initial balance identified by this blue arrow. So this is our initial balance for the day. And we have period A, and then period B comes right on its heels. Period B does not actually exceed the high of A, but it does drop one print below the period A. So technically, you might say that we have a tiny tail, this little b. All right, and as a matter of fact, it did hold for the day as the low. However, this is not a very good indication, and this is an example of when it really is difficult to identify where the high and the low would be. Even though this small tail did in fact end up being the low for the day, when before the rest of the day develops, it is a little bit difficult to discern or determine that. And I show you the difficult example first so that once again, when you see this, you don't get carried away. Just as we have one print below A, we also have 1A above B. There's quite a bit of overlap here. And in cases like this, it really is difficult to determine when this occurs, and we have to wait a little bit longer for the market to give us some more information. Now, here's where the information comes in and actually begins to give us an indication of where the high or the low is going to be. When the C period comes into play. Take a look now. C period develops above the mid of period B and starts moving higher. At this point, I now know that I've put in the low for the day, and this is my low for the day. So even though I wasn't able to accomplish that with a great degree of confidence in the initial balance period between periods A and B, once period C came into play, I was able to now determine, and it still gives me plenty of trade opportunities for the rest of the day. Because now that I know that this is the low for the day, I am comfortable taking longs and moving with them as the market moves in the direction upwards. All right, now let me give you another example where in fact it becomes very self-evident and very easy for us to identify where the low or the high or the extreme value, if you will, is for that particular day. Once again, we're going to look at the initial balance period, which is made up of period A and period B. But look at how easy it is to tell on this particular day where my high for the day is going to be. Take a look at the tail that develops for A up here, all the way. How many prints do I have up here? I have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 prints. 15 prints making up a tail up here. Immediately, this is a very strong sign that the high has been put in. There's a lot of momentum and a lot of movement in the direction to the downside on this particular day. Not only that, period B comes in, and look at what happens. Again, I caution you in period A, even when you do see this, you don't want to rush too quickly, and you want to still wait and see what happens in period B, because period B could just as easily come back in and give us some double prints, which would change the dynamics completely. But what happened was period B never did such a thing, and period B just dropped back 3 prints into A, just 3 of them, well above the mid of it, and then continued even lower. And this really highlights for us that the high for the day has been put in, and it also highlights for us that there is a strong directional momentum in this market to the downside. And in fact, all this did really hold true for the rest of the day. So now you begin to see how you gain insights with a little bit of patience and by watching the A and the B periods. I will tell you that you're not going to get many days like this one where it's like taking candy from a baby. It becomes very self-evident like this. But nevertheless, more often than not, as a matter of fact, I would say around 70% of the time, it is going to be rather self-evident where the high or where the low is going to be for any particular trading day. And once you have that identified, it gives you a level of comfort in terms of the direction in which to take trades and in knowing sort of what is the outside extent of risk on that particular day. Now, always keep in mind that things in the market may change, and so if in fact you have erroneously identified a high or a low that changes on you, you should always have in place some level by which if things change at this point, then it alerts you, well, wait a minute, maybe things are changing. And one such scenario, for instance, if we had a day like this and all of a sudden prices start to move back and we're trading back in this area, this changes the rules of the game. And I should adjust and change accordingly. All right, now take a look back again just to highlight for you the selling tail that was self-evident on this particular day. Look at how big of a tail it was. And the entire initial balance actually formed a very long tail. It wasn't only the top portion, but we also had a second selling tail in period B. So we had an early selling tail in period A, the first selling tail, followed by a second selling tail. This is a very telltale sign, not to play on words a little bit. It really gives us a great indication as to where the high is put for the day. So these tails are really helpful for us in identifying the extreme levels fairly early during the day. Always remember, look for those tails. And so now that we have the first selling tail and the second selling tail, we know with a very high degree of confidence that we've put in our high for the day. And then you should be comfortable taking shorts during the rest of the day. And unless really things make a dramatic change, then you may reevaluate and reassess. All right, let's take another look at another example, and this is more typical of what you're likely to see during the day. You're not going to see, as I mentioned, an example that's going to be as obvious as the one we just looked at, but it's going to be more subtle. So take a look at this one. This is more in tune with what you are likely to see happen more frequently in the market. You're going to get an A period followed by a B period, and all of a sudden the B period moves in a particular direction in a strong fashion. So when you see this, once again, you have a little bit of a tail down here, and you should be comfortable at this point in recognizing that you've put in the low for the day. It identified for you the extreme fairly early on. We have a small buying tail, but nevertheless, it's a good tail, and B was quite strong to the upside, and even though it came back and pierced through half of A period, we are still looking at a reasonable tail of about five prints here. So we are, I would be fairly comfortable. This is a high probability that the low for the day has been put in, and I could comfortably begin taking longs. For instance, at C period up here, and even when E drops down here, I would take a long and go up with it because I know here's my low for the day. All of these trades could generate some reasonable profit for me. The day's low is the lowest point or the lowest print that printed during that initial balance period. It is not difficult to identify the low once you have carefully analyzed this initial period, and once again look for the tails, keep an eye out for those tails, and the rule is the longer the tail, the greater the likelihood that this will hold. The tail is really evidence that we had strong involvement from the other time frame trader. Basically, we had a long-term buyer that stepped in the market and bought and continues to sort of hold the market at this point, and that's why prices are not going to dip below this low that we've put in. All right, let's take another look at an example where it really was very difficult, and in fact, we weren't able to determine a high or a low. Once again, it is difficult whenever you see that the A period and the B period have a lot of overlap between them. We do have a little bit of a tail at the top, but we also have a little bit of a tail at the bottom. So which tail is the one that's really going to hold? And whenever you see this situation, that's the situation when you really hold back a little bit, be a little bit more patient, and let the market develop a little bit further so you can identify more accurately where the high or where the low is. So in situations where you don't have the tails as evident as the ones that we've looked at, you have to be careful and you have to wait a little bit longer. And in this case, take a look. Neither the tail at the top or the tail at the bottom, neither one, the high there or the low here, held for the day. Both of them failed, and the market continued to trade in both directions above both of those lows. So don't rush to judgment, and again, be flexible, but the telltale sign is are those tails. The longer the tail, the more likely that it will hold. But as you saw in this case here, we did have a tail, but all of a sudden the B period came back and dropped, and we had a tail on this end as well. And the key here that tells us that these tails are not going to hold is really the overlap. Look at how much overlap we have, the double prints between A and B. When you have this extent of a double print, hold back, wait a little bit to gather more information. Don't get deceived by those tails. Whenever you have a market that's printing double prints in the initial balance period, it is a market of uncertainty. It is a market that has found value in this range that it has identified, and there are really no extremes. Neither side feels that there is a high level of extreme one way or the other. And sure enough, as you can see, as the day developed, neither the low nor the hold held for the day. All right, let's continue on our discussion about the open period. And as you can see, it really is a treasure trove of information for us as traders, and information you are not going to get anywhere else. Again, it is the power of the profile. So it is very important to be very attentive to this information and conduct this analysis carefully. And once again, I encourage you to always go back and retake a look at these lessons, review them, and make sure that you are very comfortable with the analysis before you embark on them on your own, and then begin to do them on your own and test and see, are they working or not? And if they're not working, go back to the lesson and see what you've missed, or where you're failing in the analysis. And if you have any questions, by all means, always make sure we tackle those in our coaching sessions. All right, now we're going to go back to the open itself, where the market opens relative to the prior day. And I always want you to appreciate and understand the significance of this. The market does not open in a vacuum. The market always opens in a context, in a larger context. And that's why we always need to look at what's been happening in the past. Certainly, the most recent past is the prior day. And so in our discussion now, we're going to focus on what happens when the open is within the value area of the prior day. We will also take a look down the road at the context in a larger time frame in terms of what's been happening in the week and the month and so on, because those also come into play. Remember, it's the other time frame trader that influences the market, and they are the ones that create the perception of value over a week or over a month. So we need to also be looking at what they're looking at if, in fact, we want to trade successfully even within the day. So let's take a look. If, in fact, price opens within a value area, what are the characteristics of a value area, first of all? And in a value area, the value area is characterized by overlapping TPOs, meaning price is revisiting these points repeatedly. And so we are getting TPOs again and again and again at this particular price level. And if that's happening, then what that's telling us is the market has found fair price in this area, and that's why we continue to see two-sided trade in this area, and that's really what creates the value for us. All right, so when we have value in the market, or when we've identified a value area, what does that tell us in turn? It tells us that, it indicates that the market is in balance. And what happens when the market is in balance? We see two-sided trade flourish. The market participants, in specific, the short-term traders, become very active, and we see more and more trading taking place. And when the market is in balance, the other time frame trader, be they a buyer or a seller, is really on the sidelines. When they step in, they push the market out of balance. And that's when we begin to see movement in the market. So I hope that you are now comfortable with these concepts, and you are able to integrate them together and see how they influence the market. So let's take a look now. We get an open, and the open actually opens within the prior day's value. And when this happens, what we need to do is we need to monitor how the price will behave relative to the prior day's value to give us insights about what's likely to happen during the day. So if I were to ask then, what are the two possibilities? If I open in an area within the prior day's value area, what are the two likely outcomes? And the answer is really fairly simple. There's one of two things that are going to happen. One, I'm going to stay within the value area of the prior day. In other words, we are going to continue trading in this same value area as the prior day. And in that case, what that tells me is the market sentiment really has not changed from the previous day. The traders still see that this is where value is in the market. This is where they're still comfortable trading. It also tells me that trade risk and opportunity are both relatively low. In other words, I'm not expecting any major moves. There's not really a lot of big money making opportunities, because once again, the other time frame trader has not created any imbalance. The market is in a state of balance. Moreover, it also tells me that the day's range, the range of the prices in which the day will trade, the day that has just opened, is probably going to be contained within the prior day's range. We're not going to see any big movement. We're going to see some overlap, perhaps to one side or the other. And we've already talked about how we estimate what this potential range would be once we've identified a high or a low. So when the market opens within the prior day's value area, I have this as one possibility. Prices may, in fact, get accepted, and we may end up continuing to trade in this same value area for another day. And if we're going to do that, I know what to do. I know I can project my trading days range, and I can be comfortable working with the other traders within this range. It may not be a very wide range. It all depends on the prior day's range, but nevertheless, I now have an idea about what the day might look like. That's one scenario that could develop. And let's take a look at it, at how it actually manifests on the chart. We have 2 days lined up right next to one another. The red line shows us the value area for the prior day, and the day next to it opens right here, as you can see, right within the value area. And as a matter of fact, it is a little bit lower than the POC. Sometimes traders will make the mistake of thinking that because they opened lower than the POC, that the market is going to continue dropping. Do not be fooled by that. Just because it opens below the POC or slightly above the POC doesn't give us any indication as to what is likely to happen during the day. That in itself as a fact is an interesting fact to note, but it really is not something that I would act on or base an early trade on. I need to allow the market a little bit more time to develop to be able to get insights that I can count on. So let's watch what happens. We open inside the value area. Now let's take a look at A period and take a look. A period goes above a little bit, so we went up above the point of control, but guess what? We're still well within the value area of the prior day. And then we drop a little bit further, but again, we are still within the value area of the prior day. So we're still in a balanced market. B period kicks in. It opens at the low here, and then it drops a little bit and then moves back up again. And now I see a lot of overlap between A period and B period. And remember from our discussions just a short while ago, whenever we see a lot of this overlap, what does it tell us? It tells us, in fact, that the market is still in balance. The market still perceives there is value in this area. And so I want to wait a little bit longer before I make any judgments. And as a matter of fact, I wouldn't prematurely call this the low of the day, even though I do have that little tail here. I'm still within value. All of this area is still value. And what the market is telling me, the market is still comfortable in this area. So it could be still comfortable going down here. It could also still be comfortable moving up here a little bit. So too early to identify a low or high. C period really is the key, and after I get C period, then I'm comfortable calling the low for the day. But it's all within the value area. Now notice also that the entire initial balance, A and B both, is still well within the value area of the prior day. So there is a sentiment of acceptance in the market. Don't expect any major directional moves. All right, when price, let's review. When price remains in the value area is basically still accepted both days, for both days. The market is in balance. All right, so don't expect any major directional moves. And again, there's no evident other time frame trader participation. This is the scenario where I open within the prior day's value area and there is acceptance. I see double prints start to occur within the value area. Now, let's take a look at the other scenario. What if, in fact, I open within the value area, but there's no acceptance? I get rejection. The market doesn't like this value area anymore. So the same thing will happen. Price will open within the prior day's value area, just as it did when we had the acceptance. But here's what we begin to see happening. Price drives out of the value area during the first half-hour period. because the market is rejecting the prior day's value area, we will begin to see that the market wants to move out of that area very quickly, and it will become apparent during that first half hour. We will not get any buildup of double TPOs as we did when we had the acceptance. So you won't see any AB next to one another in the prior day's value area. And once again, this confirms for us that there was no acceptance within the prior value area. We're looking at a new condition in the market, and basically we're looking at the other time frame trader stepping into the market, and they've decided that this is not where value is, and so they're going to move the market to another area where they perceive value to be. So there's a high and a good possibility that the market could be breaking out of balance. All right, let's take a look at it on the chart, how this actually looks and develops. I have a day here, and once again, we identify the value area for the prior day, and take a look. The market opens within this value area. Here's my open. And we begin with what you should be familiar with now, and that is an open test drive. So the prices move up to this level, which was the value area high. They test this level, and then they shoot in the opposite direction. So what happened was, when we tested this level really proved to be a level of resistance, and the market shot in the opposite direction. Now, as it did that, let's take a look at what happened vis-a-vis the prior day's value area. All of a sudden, during our first half-hour period, we begin to see that period A pierced right through the low of the value area for the prior day. So immediately, this tells me I'm moving out of the old day's value area. The value area is being rejected. So let's see what continues on to happen as this develops. The price moves all the way down outside the entire range of the prior day in period A. This is another strong indication that there is rejection of the prior day's value area. Now let's take a look at what happens during period B. And period B drops even lower than period A. The rejection is really confirmed for me by period A and period B, and even though I get double prints, take a look at them and see that not a single one of those double prints occurred within the prior day's value area. All of the double prints were outside the value area. So I have all the indications that are confirming to me that we've rejected this value area, and we're moving outside this value, and we are going to move to a new value area. There is opportunity in the market, and if I can read this correctly and early, I can move with it and benefit from the move as it begins to develop. Notice, re-emphasizing the point again, no double TPOs within the value area. All the TPOs occur below the value area. They're still in range, but nevertheless outside the value area. The A and the B double TPOs are all outside. A confirmation of value rejection. All right, now take a look. When the market breaks out below the range, we never really have a good indication as far as the day's range. We are able to call the high for the day fairly quick, so we know the high is going to be here. And if we applied our traditional method of adding the prior day's range to the high of the day, you are going to find that the market broke out well above that, and we had a much greater day. So usually what you're going to see is the day will develop as a multiple of the prior day's range. So it'll be one time or possibly two times, maybe three times that range, or 1.5 times, but it'll be some multiple of the prior range. And this is why I also taught you early on to learn to break up the range into parts. So you can see we moved, when we came down to here, about one full range plus the original of the prior day's value. So we have in this day twice the range of the prior day, 2 times it. Now we begin to look and project, could we possibly make another additional range? And this would be my outside projection. And so when I am placing my trades, this is how I begin to determine my targets for the trade. And I will talk a little bit more about this when we get into our discussion of the anatomy of trades. But you see, this is why it's important to also break up the range of the prior day into parts. So one full range, we've moved already 2 full ranges. And we could project and see how well are we doing to take up one more range of the prior day. And you will find that typically the movement will be some sort of a multiple, or will still have some relationship to the prior day's range. It may be 2 times, it may be 3 times, it may be 1.5 times, 1.25, and this is why we also need to learn to work with the fractions. All right, so let's review together value rejection, value area rejection, or the breakout trade. If we get an early breakout that drives price completely outside the limits of the prior day's range, we have a great setup for a potential trade. There's both some risk, but there's also high opportunity. Well, where's the risk? The risk is we could always be wrong and the market could turn on us. But there is a great potential opportunity. The day's range is open in direction of the initiative drive. We know now where the direction, where the market is moving. It's obviously rejected this value and it's moving in a different direction. So we call that an initiative drive in a new direction. And again, the day's range is open. It's not only going to be like when we were within the value area, limited to an equal range at the most of the prior day's range. In this case now, we have an open field. It could be twice, it could be 3 times, it could be 1.5, 1.25, 1.75. We don't know, but we know that the range is going to be open. All this is incredibly valuable information for the trader, because you are really looking at all this very early in the market and projecting about what is likely to happen. And more often than not, if your projections, if you've had some practice doing this, you are going to project fairly accurately. So let's take a look at if in fact I was able to successfully identify this opportunity. I know that rejection occurred here and I want to structure my trade. Where do I take my entry? If I'm an aggressive trader, I could take my entry immediately as soon as the break occurs outside value. This is an aggressive entry because at this point you really don't have a lot of confirmation. But you could conceivably protect yourself with stops, and I will show you where we would put our stops. But let's take a look at entries first when we get such a scenario developing in the market. So we open inside value area, but immediately period A rejects this value area. So when I see this, there is a high probability that the long-term or the other time frame trader has stepped in, they're influencing the market, and now I am looking at an opportunity in the market that is a great opportunity and with tremendous potential. And as I said, it could be a multiple of the prior day's value range. And so my first target would probably be, if we in fact put the high here, then I would tabulate one value, one range, and then my first target would be one more range level beyond the original range, or I could do half, depending again on how aggressive I was and my reading of the market and the sentiment and what's going on in the market in general. So let's begin with this as our aggressive entry. As soon as price breaks out of the value area, I would enter the market. But let's continue on and take a look at what if I was a conservative trader and I really needed more of a confirmation. Well, the confirmation comes when in fact A period in B period actually also drops below the full range of the prior day. So at this point, when B starts dropping, that would be another entry point if I really wanted to be conservative. B opened up here, so I may still be hesitant. I didn't want to act on this first entry, but look at what happened when B opened. B came back to test the value area low. And what happened? The test held. As a matter of fact, held. It didn't even go all the way up to that low value area. It printed just one value below it and then continued on lower. As it's coming back lower, this would be a good point for me to begin entering the trade. And this is a far more conservative entry because now I have confirmation. I know that we've put in the high for the day, and B period now confirms for me or confirms that in fact we are moving lower in direction, and not only that, it begins to print completely outside the range of the prior day. So we're now not even talking about value areas, we're well outside of the range. Also, you should not forget we have our footprint to take a look at simultaneously, and this gives us even greater insight because we actually see whether there's buying or selling in the market. Now that we have identified our entry points, let's take a look at where I would put my stops. If in fact I was aggressive and I decided to take the entry as soon as the market penetrates or breaks the value area, I would place my stop right at the POC. If the market changes direction and actually drops lower than the POC, then I am wrong. I read it incorrectly. Things have changed, and I don't want to wait all the way until the low of the day. The POC is a great place to place your stop, and that way you don't get hit with a very big loss. This would be your safe stop placement. Now, if in fact I took the conservative entry, take a look at where I would place my stop. Oops, went too quickly. If I took the conservative entry, the stop would be at the value low area. So I would look at where was the low value area before we actually pierced through the range, and that would be my protective stop. So in both cases, I would always have a stop to protect myself, and in both cases, you will see that that I was accurate in my analysis, and actually things went on to continue in the direction that I had anticipated for the market. And of course, as the trade develops, and we will talk about this a little bit more in just a few minutes, I can adjust my stops and move my stops accordingly. But usually I want to have an initial stop in place. All right. Now, since we have begun talking about actually identifying trade opportunities in the market and looking at how to take trades using an analysis that's based on the profile, it really behooves us to spend a little bit of time together discussing the anatomy of a trade, the elements of a trade, if you will. Before we take a trade, what do we really need to do? How should we be thinking? And this, of course, applies to any trading environment, or whether you're going to use the profile or not. This framework for structuring your trades is a very important framework that you should always follow, because it will help you to stay organized, and it will prepare you appropriately for profitable trades. The 5 key elements that I always want you to focus on if you're ever going to take a trade are the following. The first one is the duration. The duration is, what is the time frame of the trade? Are you a swing trader? Are you a scalper? Or are you an intraday trader? Are you working within the half hour, the 1 hour? What is the duration of the trade? How long do you really anticipate to be in the market? This is very important because this influences your analysis and all of your trade decisions. So you need to think of the time context. What is my framework for my trades? What is the time framework that I'm going to be active in the market with? Now, next is the entry. We're going to talk about that, the elements of the entry, and of course your target and your exit, and last but not least, analysis, justification, and score. And I will go into a discussion of each of these elements today, just a brief discussion to just identify for you what we mean and what needs to be done for each of these elements to be in place. The duration, once again to review, you need to determine, are you a short-term trader or are you an other time frame trader? And again, even within the context of either a short-term trader or an other time frame trader, you need to be more definitive about the duration of the trades that you're going to take in the market. Now, the toughest trading is done in short time frames. In other words, the scalper is the one that's really fighting the most difficult battle in the market because they really have to do a lot of thinking and make a lot of decisions in a very minute period of time. So scalping usually comes with a lot of pressure and a lot of stress and having to make a lot of decisions very, very quickly. So I typically do not recommend scalping for beginners. I recommend that you take a time period or a time frame that is going to be comfortable for you. And if in fact you want to be an intraday trader and trade during the day, then I would say start with the half-hour time frame. It is sort of what we've been working with in the profile, and it allows you adequate time to make judgments, to understand, and to follow what's going on. If you're going to be an other time frame trader, you have a lot more flexibility. You could be looking at the market in days. You could be looking half days. Again, it gives you greater flexibility and more time to think and analyze about what you want to do in the market. But nevertheless, this is one of the earliest decisions that you need to make. What time frame do I really want to trade in the market? What is suitable for me, my preferences, and my style? There is no one answer for every single trader, but every single trader needs to find the correct answer for themselves. And often it may involve some experimenting on a simulator to develop a feel for what you like, the amount of time you need to conduct a careful analysis, and so on, and test on the simulator before you ever enter the live market and determine which time frame seems to be yielding the best profits for you because it's allowing you adequate time to make your analysis comfortably before you use that time frame. But never choose a time frame because, well, my friend is a scalper and he makes a lot of money scalping, so I will be a scalper too. Or so-and-so did so-and-so, so I find what is comfortable for you. That is the secret of being successful in trading. You always have to test the waters and find what you will excel at and what you will be good at, not what someone else excelled at or was good at. Next now, after we've determined the duration or the time frame that we're looking at, we have to look at the type of entry that we're going to make. There are many different types of orders that we can put into the market, but I'm going to focus on just two of them now, and I hope you're all familiar with them. The first is what I call a market order, or what is known as a market order. I don't just call it that, everybody else calls it that. And typically, professional traders rarely trade with market orders. Market order is basically you are at the mercy of the market. You put it in and fill me at whatever price you, Mr. Market, think is good for me. And professional traders always use what we call limit orders. So I set the limit and the price level where I want to buy and where I want to sell. And this is what I'm going to recommend for you for the vast majority of your trades. Again, depending on your style, there are some instances where you may want to consider market orders, but as a professional, I never leave myself to the mercy of the market. I always like to know what price I want to go in at and what price I want to exit. And if in fact I don't get the price I want, fine, so be it. I'm not going to chase. I'm going to sit this one out and wait for another opportunity. The market is always full of opportunities. As a matter of fact, the more proficient you become, the more amazed you will be at the number of opportunities that will make themselves available to you, and you will get picky and choosy, and you'll decide, I like this one, no, I don't like this one, I'm sitting this one out, I'm going to take that one, and so on. So limit orders is what you want to focus on and what you want to use for the majority of your trades. Targets. Never enter a trade without a target. You need to always know where you're going before you start the journey. Imagine someone is going to go on a trip and they say, okay, I've packed my suitcase, I'm ready to go. They open the door and they're leaving, and then you ask them, well, where are you going? I don't know. It just does not make sense. You need to know where you're going before you begin the journey. So you always have to identify where the target is before you actually decide on taking a trade. Now, how do we come up with targets? Well, it's a product of our analysis. And already we've talked about many of the techniques that we would use in determining our targets. We talked about projecting a range, for example. We've also talked about the key reference lines and the key reference points. We've talked about support, resistance. So there is a multitude of different tools that we use to determine our targets, but we should and we must have a target for every trade. The other thing I also want you to have in the back of your mind is an approximate time. How long is it going to take you to reach that target? Quite often, if the trade isn't really working my way, I may have a little bit of profit, but things aren't working as I had anticipated, and it makes sense to take what you have on the table because it's taking longer for the market to move where you anticipated that it should have been shorter. So that's why you also need to develop this sense of time. How long do you think it'll take to reach this target? And if in fact you are a half-hour trader, well, it's going to take an hour, 2 hours. Usually by the time the market does this and that, it takes 2 hours. So if in fact I'm an hour and a half into the trade and it's still, I have some profit, but it really hasn't moved in the way that I had anticipated, it may be time to pull back. Also, I want you to understand that targets are part of our strategy, and there are some strategies where we will use multiple target trades, and there are other strategies where it behooves us to only use what we call single target trades. So we just have one target. Once we reach it, it's fine. Others where we may in fact have multiple targets. Third, your exit. You need to always have an exit plan ready for every trade. If in fact I am wrong, and we all make mistakes, and we all have, there's always a chance that things could change on us in the market. So as a result of my analysis, I should always identify where is the point that if price comes to this point, it actually tells me I was wrong. I made a mistake and I need to get out and take my loss at that point. You always need an exit in place. Now, where this exit is, and how we come up with it and so on. It should always be a product of your analysis, and also to some extent your risk tolerance. Your risk tolerance sort of determines how aggressive you are as a trader, and how conservative you're going to be. If you are more tolerant of risk, you can be a little bit more aggressive as a trader and allow for greater latitude in terms of losses. And just as we did in the example earlier, I identified for you two different entries, one based on being aggressive and another one based on being a little bit more conservative. And this has to do with risk tolerance, how much you're willing to take in terms of a loss, and basically your capital, and elements all personal to each individual. Now, the other important thing that I want to talk about stop losses, there are two different schools of thought about stop losses. There are some traders that actually never use a hard stop in the market. They decide they're going to work with what they call a mental stop. So they know where they want to get out, but they actually don't put that in there. And they decide to take themselves out at the point that they feel the analysis has failed. This requires a lot of discipline and someone who's very nimble and very quick and be at execution. Others will use a stop loss, but the stop loss actually will be at a very wide level. So it's sort of an emergency exit. It's not really where they would leave the market. And the reason is they don't want their stop to get hit and then their trade to start working out. If in fact you are using the market profile for your analysis, the stop you come up with should be a very concrete stop, and you should rely on that stop. So don't hesitate to actually put stops in the market if you're analyzing based on the profile. These other techniques, you will often hear of traders that don't have the power of the profile behind them. As you get more and more confident in your analysis with the profile, if in fact you're wrong, you should rely on the fact that you are wrong and take the stop where you placed it, because that was based on your original analysis. Don't sit there hoping, praying, thinking, oh, things will turn around. That's not how profile traders trade. We trade with confidence because we're using the best tool in the market, and we're using the best analytical techniques possible. So we have to have confidence in our stops, in our entries, and in every element of what we do. That's really the hallmark of profile traders. Last but not least, this is sort of the score, the justification. Never enter a trade without justification. You must always know the reason why you got into this trade. We've been spending a lot of time together going over different types of analysis. And each time the analysis really gives us the justification of why we're taking the trade. The last one we were looking at was, well, we've noticed that price actually rejected the value area. Price is moving now outside the value area. This tells us that other time frame traders have come into play. The market is now going to go out of balance. There's opportunity here. There's my justification. There's my analysis. I'm not going into trades because, wow, this looks good. Oh, the candle is red, the candle is green. That's not how we trade. So you always have to have a rational and an analytical reason behind what you're doing. And that's why, again, when you put a stop in, that stop is put in there for a reason. You put it there because your analysis told you to do that. Now, I always like to help beginners by also telling them to develop a point score for their justification. It teaches them to sort of break down their analysis into pieces and begin to say, okay, if I have this piece, I got 10 points. If I have this piece, I now have 20 points. And I'm not going to take the trade unless I have an accumulation of 30 or 40 or 50 points. And in addition to our justification and analysis, I will also begin to introduce you in the upcoming lessons to some supporting indicators, some other tools in addition to the profile that will help confirm or validate that you are on the right track. They will confirm that you are in fact making the correct analysis. The more things of these that you have in place, the greater the probability of success and the more confidence your level, the higher your confidence level will be. So for example, is the direction that I'm going to take in the direction of the major market, in the major market trend? If so, give yourself 10 points for that. In the beginning, you will need those as a tool to help you, but as you become more and more proficient, this will be a very quick mental exercise. It'll be almost like mentally you'll put check marks next to each of these items on your checklist, and you will see, aha, this is a good trade that I could and I should in fact take. Is the trade in the direction of the day's trend? Is there volume in the direction of the trade? Am I entering at a point of support, or am I entering a short at a point of resistance? Indicators that we will look at, one indicator that I like in particular that I will share with you how to use is a stochastic. What is the stochastic telling me in addition to my market profile? Does this make sense? Do I have the support of all the elements to justify my trade? By the time you do all this, you will become an incredibly confident and effective trader. So learn to develop these habits, review all of these elements again that we talked about in our lesson. I'm quickly going to go through an example with you of how we implement some of these elements of the trade. So I'm looking here at a profile of several different days. We have about 1, 2, 3, 4, 5, 6, 7 different profiles, and I'm going to show you a easy and quick technique to sort of structure a trade based on the elements that we just discussed. Let's identify all of the POCs, and all of you now, this should be a piece of cake for you. We identify the value of all of these POCs for the past 7 days, and now we are going to calculate the average for these POCs, and simply that means add up all of the points of control and divide by 5. We're going to look at just 5 of them for 1 week, and we come up with the average POC, and then the average for 7 days, and we will find that they're both fairly close. So now we have an average POC for the past trading period. Now we take a look at the open of the new week, and all of a sudden I see, and you're going to see things now that many other traders don't see, you are opening above the value area of the prior week. So already you know that the market is out of balance. You are opening above the average POC because you've calculated that, and that gives you some additional confidence. You are also opening above the value area high of the prior day. So look at all these things that are telling you in your analysis the market is very bullish. You are also opening seeing large volume at the open. Look at this bar here at the open, right here in front of the open, and look at the greatest. It's about the same size as this number of TPOs. So immediately you're seeing large volume at the open. All right, so you begin to tally up your score. The direction is in the direction of the major market trend, 10 points. Direction is in the day's trend, another 10 points. Volume in the direction of the trade, 10 points. Entry at a support level, yes, the support is right there at the high, value area high, 10 points. I did an analysis, 10 points, so I have 50 points. It is legitimate for me now to place an entry right at the open. Since we have a possibility of a strong directional move, a multi-level target trade is possible. Whenever you have these potential explosive or large moves in the market, this is when you should begin thinking about multiple targets rather than just one single target. If in fact our trade was going to be confined into a limited value area, or we saw that we weren't going to have this tremendous move, then I may be inclined to use a single target. Our long entry, let's say I decided If the market pushes up right at 11.25 up here, I will let it take me with it and we'll go on up. And as a stop, I'm going to put my stop at 1180 right here at the low of the day, just one tick below the low, because I'm being aggressive because my analysis and the context tell me I've identified a great opportunity in the market. Target 1, well, let's see if we can make it to the high. This will be my first target. And remember, I identified this as a multiple target trade. My stop at 1180, we've identified it here. If in fact we're wrong and the market moves in the other direction, this would be a safe stop. Target 2, my next POC level. So target 1 was the high. My next one is target 2 at the next POC. Target 3, the high of the prior week. See, I'm selecting all of my targets based on the analysis that I did. And I'm using a dynamic stop strategy. The dynamic stop strategy tells us that as I reach each of my targets, I move up a little bit. So once target 1 is reached, I move the stop to the entry price. Once target 2 is reached, I move the stop up to the original target 1 price. And now for the third target, if I want it to be conservative, once price is 50% above the range from target 1 to target 2, I move the stop to target 2. And if I want it to be aggressive, I would move the stop to half the range between target 1 or target 2. All right, now I'm going to show you a video to quickly show you how this trade manifested itself. Okay, the video isn't playing for us, so we might take a look at it in the lab, but the trade worked out for us incredibly well and continued on to fill target 1, target 2, and target 3. And here were the trade results from this particular trade. If I in fact had started out with 10 contracts, this would have been the outcome as I hit each of my targets. Stage 1 would have given me 187, 1050, 131250, a total of 2,250 for the day. If I had only started with 3 contracts instead of 10, at stage 1 I would have gotten $62, 262 at stage 2, and stage 3 437, a total of 762 for the day. Not bad under either scenario, but the key is the analysis and following the rules for our trade. So always remember, take a look at your trade and identify the analysis that you're going to base it on. And as you can see here, always look to see what is happening in terms of the prior day and where are we opening relative to the prior day. It is very important to look at the open, where the open is relative to the prior day's value area. All right.